Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk feature interview series. And I'm delighted today to have joining us Mr. Harry Tchilinguirian, who is the Group Research Director at Onyx Capital Group based in London. Thanks so much for joining us, Harry, for your views today on where we are with the energy markets.
Well, thank you very much for having me.
Well, great to have you. Let's start by asking you about a bit of a sort of pricing outlook. Of course, Onyx does many things, but it does have a big focus on pricing as well. And I know I'm not asking you to tell us where oil prices are going, but what I do want you to comment on, if you can, is how much of this risk premium that the market's been sort of talking about for a few months now, given, of course, the geopolitical backdrop of what's happening here in the Middle East where I am. How much would you say is there a risk premium in the oil price today? Because we haven't had it there for long or for much in the last few months, despite events that we see going on.
Well, that's a really interesting question, as well as being a very tough question. In essence, that means that we could determine what would be a fair value for the price of oil, and then identify the difference as being the risk premium. And of course, within that risk, being able to identify what belongs to the geopolitics in the Middle East. So when we look at the evolution of prices, in particular where we're trading at prior to the Iran attack on Israel on the 1st of October, we're in the circa $72 a barrel for Brent, and we moved as high as close to the 80s, and then we've come back down. So, using an economist's terms, all things equal, we may have had anywhere between $5 to $8 of risk premium if everything else more or less remained the same. What is extremely interesting is the fact that this risk premium varies over time. So depending on the perception that the market has over the retaliation of Israel, the scope of that retaliation, the nature of it, that risk premium is going to change. So interestingly enough, despite, I think, a consensus that Israel will strike back in its own time, we're still trading below $80 per barrel this morning. So effectively, that risk premium could be characterized as relatively modest.
Yeah, it is. Certainly considering what's been happening. And interestingly, it did bump up, didn't it, when we had that activity a week ago, but then quite quickly sort of calmed down. Harry, let's talk a bit about sort of the macro then, not macro, sorry, the fundamentals of oil on the ground, because despite everything that we're seeing in the last year, we haven't seen any major physical disruption, hence why prices have remained tempered. Of course, the other side of it is demand. But on the fundamentals, the outlook, let's talk about demand a bit, looking into next year in the context of OPEC, perhaps looking to add more oil. Do you think that they can, in 6 weeks' time, actually proceed to do that, given that the outlook looks pretty weak going into 2025?
Well, I think you nailed the point. It's really an issue of demand rather than supply at the current moment, because we effectively hadn't had any disruptions to either oil production or any major disruptions to oil transit. So it's a question of how people see oil demand evolving. And one big aspect of that is people's forecasts are around China. So OPEC is faced with a bit of a conundrum for the fourth quarter. Is it in a position to be able to increase production? It's delayed such a decision in terms of reduction of voluntary cuts to December.
Yeah.
I think, there are two ways of looking at it too. Some people look at it and say, well, if they do add more oil, the market's not really able to absorb it, and therefore prices may fall. But at the end of the day, if there is a surplus, if they were to add more oil, we're looking at oil inventories in OECD countries, but global inventories, onshore inventories of crude stocks being relatively low. So I suppose OPEC, which is often looked at this metric of OECD inventory, especially the 5-year average, and says, well, you know what, we could actually probably add a few more barrels. If they don't get fully absorbed, they go into stocks, but stocks are relatively low. So price impact the shape of the forward curve could change to be able to accommodate moving this oil, should it be in surplus, into storage. Maybe the impact on the flat price, the absolute level, is not going to be that great. So I think people tend to focus too much on the implied change in inventories for the fourth quarter and maybe the first quarter, without actually looking at the level of inventories from which that change will take place. So long way of saying to you that I think there's a window of opportunity for OPEC to distill back carefully, judiciously, oil into the market.
Yeah, great. Yeah, I mean, as you said, the inventories are quite low at the moment, aren't they? They've sort of been depleting, and there's a bit of a cushion there, I suppose, for them to fill that up. I mean, Harry, just let's talk a bit about the, from an oil, again, back to sort of an oil price point of view. Technically, we just had our podcast this morning, and the sentiment on there was that there is still quite a bit of downside to the price to come from a technical point of view. I mean, just talking a bit about the money market funds and how that feeds in, if you like, regardless of inventories and fundamentals. I mean, they're related, but they're kind of not sometimes, aren't they? So do you think that, the short sentiment that we've been having is dissipating? What would it take for the market for those funds to go long again?
Well, certainly in terms of the funds versus fundamentals debate, funds up until recently, up until last Tuesday, for the latest data, have indeed been very short. The narrative they've been following in positioning has been one of basically pessimism relative to the macroeconomic outlook, again centered on China. And so in the most recent data, we had an uptick in the positioning of these funds. Managed money funds on Brents have seen their net long exposure increase on Brent futures. But again, overall, historically speaking, the positioning is still characterized as relatively low. And I think that, when it comes to what the funds are doing, there's obviously a clear hesitancy right now to deploy risk. And that hesitancy is really related to the macro narrative that was already there prior to Iran's attack on Israel on the 1st of October. And that narrative is particularly pessimistic in terms of people being disappointed by measures that China is trying to take to revive its economy. Obviously, weakness in Europe, when you look at such countries as Germany, where the manufacturing sector is struggling, big countries like France that obviously have fiscal issues. And then the big question mark, of course, all the way to the Western side is, can the U.S. deliver on a soft landing?
Well, so far it has delivered on the soft landing. The Fed has been given kudos for doing that, and at least the rhetoric and the sentiment is, oh, that's succeeded so far. But of course, I think we seem to have gotten the U.S. to a bit of so maybe a new uncertainty going forward. So what next? Soft landing so far, so good. The U.S. economy is doing okay, although there's signs that might be things feeding in to kind of bring that sort of slightly less robust outlook. But how nervous or how much attention is the oil market, for example, paying now to forward Fed policy? Like, what's next, or is it comfortable that it can tell what's going to happen?
Well, I think as far as the U.S. goes, our view is that it's going to be steady as she goes. Now that we had CPI numbers and unemployment numbers being relatively positive, the Fed doesn't need to do outsized 50 basis point cuts. And so as a result, in terms of, potential dollar weakness that may then feed into higher oil prices, I think that aspect is a little bit discounted. No, really, I think the big issue is, once again, China, because China has always been the biggest contributor to oil demand growth in the past years, and not just oil demand growth, industrial commodities in general, likes of copper, aluminium, for example. And so in terms of the macro uncertainty, if China slows down, doesn't achieve its 5% growth target, who's going to be there to pick up the slack? Even a country like India, that has been performing very well in terms of GDP growth, has seen in the past couple of months, also maybe due to exceptional circumstances, some contraction in demand. But the slack that China may leave is not going to be picked up by India alone. So that overarching narrative around demand that you talked about, and the weakness in demand, is still pretty much with us when it comes to shaping expectations, therefore deploying risk, and seeing that oil price basically capped under $80 for now.
Yeah, I mean, that's certainly what would seem to be the outlook. I mean, China, we just had somebody on earlier today on the Daily Markets podcast who gave us an interesting stat that this year, 2024, um, uh, China will account for only 30% of Asian demand, whereas last year, 80%. So we've already lost 50% of that boost this year. What's
Yeah.
coming next year? And China's been very clear of its economic policy going forward, with much less support for those commodities, whether it's oil or steel. It's the property sector. It's kind of abandoning that strategy and moving into innovation and, EV
Mm.
and etc. So I mean, so has the market, do you think has the market, the oil market and traders accepted finally that China at best will be giving us 5% GDP growth, and even with that growth will not that won't all be feeding
Mm.
into oil demand per se, other kind of energy demand maybe.
Yeah, I think that right now the market is indeed pretty much, as far as expectations cementing around a number. The growth targets in terms of China, if you look at the sort of consensus forecast for GDP growth, maybe they achieve 4.8% this
Mm,
year. Next year, it's going to be slower, maybe 4.5. At the end of the day, I think there's been a lot of disappointment around stimulus measures. So China pulled the monetary bazooka, if I could put it that way, reducing repo rates, reserve requirements at the commercial banks, a number of other dispositions to buy a second home, even
yeah.
afford liquidity for people to buy stocks. And so when you look at that, you go, well, that's really going to benefit the financial sphere rather than the real economy. And given also the hesitancy in China, you can't have a monetary expansion if you don't have demand for credit. So before people go and buy big ticket items or investors invest into whatever projects, therefore are willing to get indebted, there's a step. On the other hand, we just had this past weekend the Ministry of Finance come up with a follow-up in terms of potential fiscal measures, and a number of people were expecting the central government's deficit to increase by 2 to 3 trillion renminbi. They didn't give us any numbers or any timeline, and what was most disappointing, I guess, in terms of the communication was a lack of guidance in terms of support for consumption. So when you put all these things together, you start looking at that and you say, well, if China, that has been the driver of global oil demand growth, is not going to deliver on its GDP growth targets, then we should be having global oil demand growth closer to the more conservative estimates that we're seeing
Mm.
out there rather than the, let's say, more enthusiastic ones.
Yeah, exactly. I mean, I wanted to ask you about that in terms of going forward. We did see a divergence in those forecasts in the last
Yeah.
year or two between the IEA and OPEC. And they may have narrowed a little bit as this year has gone on. But
Mm.
we still saw from OPEC's last monthly report a very positive, much more positive outlook for demand. And they've been quite accurate. You would have to argue on the whole. I mean, we don't know this year ultimately, but generally speaking, in terms of how they've managed the market. I mean, back to OPEC then. I mean, just to kind of grill you on that a little bit. As you said, they may go ahead in December because inventories will allow it to start to sort of just
Mm.
trickle in some more volumes, which are not that extensive. But of course, let's think about next year and the ultimate aim for the 12-month ahead. Um, would you from a sort of policy point of view, there's been a lot of talk about also the group itself.
Mm.
You've got members like Iran and Venezuela who are sanctioned. You've got Russia who's
Mm.
sanctioned. Um, are we still going to see that group function as well as it has, arguably, in the year ahead, given we're in a softer market going forward?
Oh, the perennial question about OPEC's
Yeah.
cohesion and existence, and
I mean, how
there's
how how important is it that it stays in a cohesion,
well,
let's say?
I mean, it is very important, obviously, in terms of managing supply and being able to distill the right amount back. And Saudi Arabia, the UAE, they may have had differences in the past. They seem to be aligned. Of course, keeping Russia as a partner within this OPEC plus group is extremely important. Maybe not if for the barrels, at least in
Mm,
terms of image when it comes to producers. I think that OPEC has had its ups and downs, but right now they're still in a pretty good place when it comes to managing policy and coordinating their supply policy. Of course, some countries behave better than others when it comes to compliance, and we've seen countries like Kazakhstan or Iraq or even the UAE
Yeah.
oversupply. Today, I think Iraq came out saying that it had compensated, for its overproduction by reducing output. At the end of the day, OPEC will, I think, as an organization, and OPEC Plus will continue. And so far, they are in alignment. So I don't see any reason for a lack of cohesion or a cohesion breakdown as far as the organization goes. Then after that, it's really a question of how OPEC sees the market when it comes to
Yeah.
what it wants to do. And you highlight differences in forecasts. The OPEC secretariat certainly has more robust growth figures. Perhaps, one could attribute some of that robustness relative to, say, the IEA or the US EIA, or even the number of banks and consultants out there. You could attribute that maybe to a greater enthusiasm, if I could put it, when it comes to countries like China, because again, we're turning back to China all the time, but it is a driver. So if you see demand from the petrochemical sector for
Mm.
feedstocks such as naphtha and propane remain strong, whether you believe that jet demand internationally for China is going to recover, and you have a higher GDP growth assumption, then yeah, you're going to end up in a place that's more bullish on the demand side. But I think that even OPEC eventually will see the data play out and respond in kind when it comes to its forecasts.
Yeah.
It doesn't detract from the fact that the organization, as it has so often in the past, considered market conditions, and so far so good. They have been managing supply in a way that keeps the price up, and I think is relatively satisfactory for both consumers and producers.
And what about then? I mean, there any concerns that the group should have about non-OPEC producers? Obviously, you've got the US production that's been pretty steady in the last year, more or
Mm.
less around 13 million barrels a day, and the forecast is it probably won't diverge too much from that. But what about, obviously you've got the Brazils, the Guyana, which are again benefiting from these higher prices that OPEC has helped support, and
Mhm.
and taking incrementally more of that market share. This whole market share argument outside of OPEC, do you think they pay much attention to it? They did, obviously, many
Mhm.
times the last decade, but that's not their focus right
Mhm.
now.
I think that, it's not so much a question of market share as far as OPEC goes as revenues, right?
Right.
Because in essence, if you could
Yeah.
achieve a certain target revenue or satisfactory revenue with less market share, higher price, then you're good. When it comes to market share in general, we've seen a number of pundits opinionate on whether or not OPEC will start that market share war again, whether it's internally or with non-OPEC plus producers. We understand that, last time OPEC tried with U.S. shale, at the end of the day, it saw that the benefits were certainly very little. The price cratered, and basically everyone was unhappy.
And I
There,
mean on
you know,
yeah, on the US shale front, Harry, sorry to interrupt you there. I mean, we've seen a lot of consolidation obviously there in the last year or
mm,
two. And arguably those larger companies more resistant to any sort of oil price fluctuation, less sensitive at least than they used to be
yeah.
as small players. Does that mean we could see significant increase in production from America?
Well, I think you said something extremely interesting. Obviously, we're looking at the U.S. shale industry as being a very different animal from when it first started. The days of drill, baby, drill are gone. Even if Donald Trump were to come back as the 47th president, then we're not going to see the U.S. shale industry uh, uh, essentially producing a massive expansion in supply. They are more integrated with the majors. The decision-making process is different, and essentially you have a maturing industry. So whereas basically before, when it came to shale, we used to look at the rig count, and then that would give us a certain level of production. I think what they're doing now in terms of capex investment spending is they target a certain level of production that seems reasonable, and then deploy the rigs accordingly rather than the other way around. So you have to think about how the
Mhm.
likes of Exxon and others that have invested the space, their decision-making process. So I think that, as far as shale, we're not going to have this sort of explosion in supply should oil prices rise to higher levels. It's a much more managed supply. And true, it's also far more resilient, which then brings us back to it would probably be very unproductive to engage in a sort of price war or market share war with US shale, but it's not necessarily a threat. The pace of US shale expansion this year, next year, in the years to come, is probably going to be more moderate and not what we saw at the inception of the industry way back in 2010.
Yeah, and is there any more room for M&A, or has everything been bought really in that sense? Should we expect any more M&A activity on that front?
Well, I mean, the shale sector is, I mean, fairly large and diverse. Yes, the bigger independent producers have been absorbed, but it doesn't
Mm.
necessarily mean that there's not room for consolidation. And we obviously, when it comes to ownership of acreage that is productive, then you can see more consolidation in the industry. So I think we're now at a shale, maybe not 2.0, maybe 3.0 or 4.0. It's I think the industry will mature, and as it matures, how it manages supply growth is going to be in a very different manner than what it did at its infancy, which was the price is high, let's drill.
Harry Tchilinguirian, Research Director at Onyx Capital Group. Thanks so much today for joining us on
Thank
Halftime Talk.
you.
It's been great to have you.